welcome to week 16 of business law. This week we're going to be talking about business organizations. So we'll be looking at the different legal entities we can form in order to carry on a business. And that includes things like corporations, partnerships, limited partnerships, LLCs, and so forth. And we'll also talk about why we want them, how they operate, and factors to consider when we're trying to pick one out for the business that we're trying to get off the ground. Before we get into that, let's talk about why we need a business organization. Why can't you just, start making widgets? Why do you have to go through any kind of legal formalities to form some kind of legally existing company? Well, let's look at the following scenario and try to illustrate this problem that we're mainly dealing with here. Jerry is an entrepreneur who invents a type of scooter that kids everywhere love. Jerry started his business building scooters in his garage and never went through any legal formalities to form his business. He just started building scooters and selling them. When people buy his scooters, they write a check made out to Jerry. Jerry puts the money he makes from the business in his personal savings account. All goes well until one day reports start coming in that the cheap Chinese bolts that Jerry used to hold the front wheels on his scooters are breaking. Kids all over the place are being injured by Jerry's defective scooters. Lawsuits start being filed, naming Jerry as a defendant. Eventually, successful plaintiffs not only take Jerry's business, but also his home, his household furnishings, his car, his boat, and his house on the lake. Jerry loses everything. All right, well, let's take another look at those facts, but let's change them up a little bit and see how the story ends differently. Jerry wants to start building scooters, so he founds a corporation, Scootco Inc. Jerry is the president of the corporation and owns all of the stock. The corporation opens its own bank accounts, and Jerry is careful to keep his personal assets separate from the company assets. Jerry's scooters start to malfunction and injure kids. Successful plaintiffs bring suit and are able to seize all of Scootco's assets. However, they cannot reach Jerry's house, his personal bank accounts, his car, or anything else that is not held in the name of the corporation. So in our first example, Jerry was basically homeless and on the street because of his defective scooters. Here, however, Jerry keeps his house and his car and his house on the lake and all that other stuff. He loses his business, but he keeps all of his personal property. So very different outcomes depending upon how he organizes his business legally. So the example that we just looked at illustrates the primary reason for having a business organization, and that is to limit the liability of the business owners. If you start a business, you're taking a risk. Certainly you can lose whatever you've invested in your business, but what you don't want to have happen is for your family home and checking account and all that other personal stuff to be exposed to legal liability based only upon what the business is doing. So if you lose everything you have invested in the business, we understand that's just a risk of doing business. That happens all the time. But what we don't want you to do is lose your house in the process and all that other stuff. We want you to still have a roof over your head and clothes on your back and all that kind of thing. As a society as a whole, we want to encourage investment and entrepreneurship. If everyone who invested money in a business, however, was subject to personal liability and could lose their shirts just like Jerry did on our first example, who would want to invest in a business? If you'd had investors that were investing in this scooter business, they would have not only lost their investment, they might have lost all their personal belongings as well. Can you imagine if you were buying a single share of General Motors stock, if that meant you could lose all of your personal assets if someone sued GM for making a defective product? Would you want to own GM stock? Would you be willing to invest in these companies that you weren't managing if it meant that you became an owner and thus you became liable for all the bad things this business did that you had no idea about because you don't know what they do on a daily basis? Well, if that were the case, then that would basically freeze up the investment market. So in order to encourage commerce and investment in the economy, the legal system provides several ways to operate a business that shields the owners of the business from personal liability. And so that will encourage them to go ahead and invest in the business without fear of losing their shirt. Let's now take a look at the different types of business organizations that we might possibly have. The first one is what we call a sole proprietorship. And this is the simplest one that we can possibly have. It's the one where Jerry was doing that in the first example. He just started making widgets, started building these scooters in his garage under his own name. He was the sole owner of the business, and that's just called a sole proprietorship. We have sole, meaning one, And proprietorship, meaning somebody is going into business for themselves, selling something. And so it's just one person hangs up their shingle, da-da, you have a business. Just one guy doing business on his own. When doing that, he might adopt a business name. He could have called his business Jerry Scooters or something like that. And when that happens, we call that a doing business as name, or DBA. And you actually have to register those with the Secretary of State's office in Missouri to legally do that, have it on your checks and that kind of thing. But you can't really separate his personal assets from the business. Just changing your name to Jerry Scooters doesn't change the legal organization of your business. So it wouldn't change the outcome at all. It's just one guy having a business and unlimited liability, as we saw in that example. Well, we can classify business organizations really by two major characteristics. One is liability, which we already looked at, and a little bit, we'll look at a little bit more. And the other is taxation, how the profits from the business are taxed by the IRS. If the business is sued and we have a sole proprietorship, well, that just means Jerry's being sued personally. His name is on the complaint, and the sheriff serves him when he gets sued because it's him. The business is not separate from him personally. So a sole proprietorship does not in any way limit the owner's legal liability. It doesn't matter if you have a DBA and you call it Jerry Scooters or whatever. It's Jerry, and he's going to be liable personally in an unlimited way for any bad things that happens in the course of the business. In terms of taxation, what the IRS thinks about this, if the business makes money, Jerry's going to pay taxes on the business income on his own personal income tax return. And so the business doesn't file its own tax return because the business is Jerry. And so Jerry files his own tax return, and if something goes wrong, he gets sued and so on. So the business doesn't file its own tax return. It's not a separate entity. The business is really just Jerry. And so Jerry's going to pay taxes on the income from the business and a self-employment tax, which will be so much fun. But he's going to be putting that on his own 1040 form when he files his taxes. All that business income will be on his personal income tax return. So that was a sole proprietorship, the simplest form of business we can have. Just somebody says, today I'm going to be in business, and starts doing business kinds of things. Well, probably the second simplest thing we have is a partnership. And that differs from a sole proprietorship in one basic way. You have more than one person involved. So what if Jerry had a friend called Buddy who wants to go into business with him making scooters? Well, maybe the two guys just start making scooters one day and decide to share in the cost of the business and also to split the profits in some way or other. Well, what they have done is they're now both owners of a business, and it's a partnership because a couple of people that come together to do business this way, kind of like a sole proprietorship, only it's not sole, there's more than one proprietor, so we just call that a partnership. There are actually uniform laws governing partnerships, kind of like the UCC, only it's not the UCC, but it's a uniform law, very much like that. And all states have adopted either the Uniform Partnership Act, or UPA, or a later version called the Revised Uniform Partnership Act, or RUPA. The UPA defines a partnership simply as an association of two or more persons to carry on as co-owners of a business for profit. So pretty simple, just two people that start in making their widgets and trying to make a buck on it. To start a partnership, you don't have to file any paperwork with any state agency or anything like that. No formalities involved. As soon as they start operating the business, a partnership, ta-da, has been formed automatically. A partnership is not a separate legal entity either, just like a sole proprietorship. If you want to sue a partnership, you have to sue the partners. There is no separate legal entity to sue. So if you want to sue Jerry and Buddy, you have to name them both. If there's scooter brakes and you're suing the partnership, you have to name them both as individual defendants, and that's how you would bring suit against them, because there is no partnership to sue. Also, the partners have no protection against liability from their business dealings. And so, just like the sole proprietorship example, if the scooters start breaking, Jerry and Buddy are both going to lose their house, their car, their boat, and whatever else. Law firms used to commonly be partnerships, and you will hear a lawyer, when he gets promoted and gets to share in the profits of the business, oh, he's made partner, and so that's very important. Well, law firms used to be just plain old garden variety partnerships. They've gotten much smarter than that now. That was a bad arrangement. And there was a pretty famous case that came out of Texas where it was a huge law firm and they had, I don't know, dozens, maybe hundreds of partners all over the country. And they had a law office in every major city. Well, one of the partners in Houston or Dallas or somewhere ended up doing some really naughty things and got sued big time and basically put all of his partners in the poorhouse because they were all personally liable and he had done something really, really bad and got sued. And so basically everyone that was part of that law firm started losing their shirts over the deal. So that kind of made all the lawyers across America sit up and take notice and figure out that was a bad idea. So anyway, we'll look at some alternatives to partnerships, but that is one major drawback is that you have no limit to your liability. You are just personally liable for all the business dealings of the partnership if you are a regular partner. As far as taxation goes, income from the partnership is accounted for on Jerry's and Buddy's personal tax returns, just like the sole proprietorship. Income from the business is personal income to them. The partnership is not a separate entity, so it doesn't file its own tax return. So as far as the IRS is concerned, the partnership income is really just income for these two guys. They will pay taxes on it just like they'd made the money working at a job for somewhere else. They will pay the self-employment tax, which is beyond the scope of the class, but it's bad. It's really bad. Lots of money. Anyway, but as far as the IRS is concerned, partnership income is personal income. So their own personal 1040 forms is where that will show up. Well, let's look at something called a limited partnership. The issues of liability and taxation really weren't that important a couple hundred years ago. We didn't really have class action suits and products liability cases running around that much in the 1700s. But after the Industrial Revolution came along, there were huge businesses that started springing up, and there started to be huge potential for legal liability, and there was a desperate need of venture capital. And so not only did the potential for liability really grow like crazy, also we needed investors in order to get these businesses to grow. And in order to encourage investment, we had to limit that liability because people didn't want to lose their shirts putting a little money into some kind of business venture. To expand their businesses, entrepreneurs often had to attract investors who would be willing to pony up some cash to help run the business in return for a share of the profits. But these investors, they really didn't want to run the day-to-day affairs of the business. They just wanted to quietly sit back and hope that they got a return on their investment. Of course, the problem was that these investors would become co-owners of the business if they invested money in it, and that would mean they would become partners with the entrepreneur who ran the business. Thus, the investors would become personally liable if the business got into trouble, even though they exercised no control over the daily business operations. They just, put in $100,000 or whatever, and hope to sit back and start collecting checks, as profits on their investment. They didn't want to run the business and, be in the meetings every day and figuring out all this stuff. But, if these widgets blew up from the company they're investing in, guess what? They're going to lose their house and their buggy and, whatever their personal assets might be. Well, this made investing in a business a scary proposition because you ran the risk of losing not only your investment, which, we would kind of expect, that's just the risk of being in business, but they might also lose their personal home and assets. And so this was very scary and did a lot to discourage investment. Government saw this as a real problem because they wanted to encourage investment. Investors provide the money that allows businesses to grow. And businesses do lots of good things. They employ people and give them jobs. They generate tax revenue for the government. And in general terms, they improve the quality of life for everybody throughout society. So the government saw there needed to be a mechanism where people who weren't running the business could invest money without becoming personally liable for any and everything that the business did wrong. The answer to that was the limited partnership. And this was adopted pretty early on in England, which after all is where the Industrial Revolution started, and is the reason that you will see many British companies with LTD or limited after their name. And that just stands for limited partnership. It's just kind of telling the world, look everyone, we're a limited partnership. And so that became a very common business form in the 1800s in Britain and was adopted to encourage this investment. In America, there was nothing like a limited partnership in the common law. So, from medieval England, of course, this was unknown. And so it was a creature of statute, both in Britain and the United States. And so in the United States, states started passing the Uniform Limited Partnership Act, or ULPA, and later the Revised Uniform Limited Partnership Act, or ROLPA, in order to create this kind of entity. So we would have that in the United States as well. And so by statute, they created an entirely new business form called the limited partnership. In a limited partnership, we have two kinds of partners. There's the general partners, who run the business and have management authority. And these are like Jerry and Buddy in our earlier example. They're the entrepreneurs who are out there promoting the business and handling its day-to-day affairs. And they remain personally liable, even though it's a limited partnership, just like in a normal partnership. They can lose their shirts if the business is sued, just like a regular partner would. But then we have a second class of partners. They are investors who do not exercise any management control. All they do is put up capital for the business and get a share of the profits in return. These are what we call limited partners, and they are shielded from personal liability. And that kind of makes sense because they're not really running the business, so why should we hold them responsible for what the business does wrong? That's what the general partners are for. And so they can just passively invest in the company without running the risk of losing their shirts. So if the business is sued, the investors may lose the money they invested. If they put $100,000 in the company, they may lose that if the business goes under or something, but they won't lose their house and their personal assets. Only if the limited partners start trying to have some kind of management control over the business will they incur any personal responsibility. So if they start trying to throw their weight around and call the shots, then they might end up kind of crossing that threshold and become more general partners. But if they just stay as passive investors, they're going to be okay. Well, this arrangement did a lot to encourage investment and help the economy to grow, because that made people feel a lot better about sinking their money into some company without worrying about if they were going to lose their house and their buggy and everything else that belonged to them personally when they did that. When we look at taxation, a limited partnership is taxed just like a regular partnership is. That is, there's no separate legal entity here to tax. They're just the people who own the business. And so, again, they will just put that on their personal 1040. So income is just, from the partnership, is just taxed as personal income, no difference there. Each partner will file a personal tax return, which will account for the income from the business. Even so, though, there are some formalities involved in starting a limited partnership. The partners have to file a certificate with the state in which they are operating. In Missouri, that's the Secretary of State's office in Jefferson City. That contains certain information, including the name of the business and who the general partners are. So if somebody wants to sue the partnership, they will know who to name in the lawsuit. So it's not really a separate legal entity, but they still have to file for this certificate. Well, there's another kind of business form called a limited liability company, and this is a pretty recent invention. In 1977, the state of Wyoming decided it wanted to be a mecca for people wanting to start a business. And so they passed a new law to make that really easy to do and create a new type of business entity called a limited liability company, or LLC. An LLC is designed to take the best parts of a limited partnership and make them even better. It's really designed for smaller businesses. We don't expect General Electric or General Motors to be an LLC. Usually works better for smaller businesses, but it provides a great deal of flexibility and even more limited liability and also favorable tax treatment. Now, LLCs are way past Wyoming. They're available pretty much anywhere in the United States. An LLC is formed when you file paperwork with the state in which you're forming it. It normally has to have LLC somewhere in the name, so everyone in the world will know what type of entity that it actually is. An LLC doesn't have partners. It has members who own the company, and so we just kind of change the terminology a little bit to show that it is a different sort of arrangement. A partnership does not have centralized control. Every general partner has an equal voice in the business operations. An LLC is a little different than that, though. It can work that way, though, and if it does, it's said to be member managed. So if the members are the ones that are actually running the company, then it's a member managed LLC, just like a partnership would be. All the general partners would run that business, and an LLC can be run by its members. However, an LLC has an option. Instead of doing that, it can have a CEO who runs the business, and it's then, when we have that arrangement, we say it's a manager-managed LLC, which sounds a little bit redundant, but we know that there are two different arrangements. It could be member-managed or manager-managed. All members of an LLC have limited liability, and unlike a limited partnership, it doesn't matter if they take an active role in the business or not. If you're a member of an LLC, you have limited liability, period. So we don't have to draw that distinction between general partners and limited partners. Everyone enjoys limited liability if they are a member of the LLC. Even though an LLC is a separate entity for most purposes, it is still taxed like a partnership, and so it acts like, a separate legal entity. But as far as the IRS is concerned, any income that comes from the business is going to be apportioned among the various members, and they will all have to pay income tax on the business earnings on their personal 1040 returns. So it basically is taxed just like a partnership, even though it has some cool features that make it more limited liability for the people who actually own the business. When we have tax treatment like this, it's said that the income from the business passes through the LLC without being taxed and goes directly to the members. And this is called pass-through taxation. And it has benefits, because we'll look at the alternative to it when we look at corporations. And the tax treatment of corporations is much meaner than this. And so the income basically just goes right through the LLC and into the pockets of the members, and is only taxed to them as personal income, and so the business itself doesn't have to file a tax return. Another option is the limited liability partnership, or LLP. For probably 1,000 years or more, English and American common law held that partners were always liable for what the business did, even if the liability was caused by something another partner did. They were all equally liable for the debts and liabilities of the business. And so, going back to our early example, Jerry and Buddy making scooters, if Buddy did something horrible, Jerry's going to be on the hook. And if Jerry does something horrible, Buddy's going to be on the hook. It doesn't, if one partner does something horribly wrong, then everyone is going to suffer and be liable. Well, that began to change when the limited partnership was developed, and then the LLC came along and gave everyone limited liability. And after we had that in the law, it seemed really kind of silly to stick to the old rule and not let all the partners have limited liability. After all, states figured out if they didn't make favorable laws for businesses, then businesses would leave that state and go somewhere else like Wyoming that gave them better legal treatment. And so states started figuring out they needed to make some changes. And so, based upon that, many states have now adopted statutes which allow for the creation of a limited liability partnership, or an LLP. An LLP operates a lot like a traditional partnership, except it gives all the partners limited liability. Taxation works just like a normal partnership, with income passing through to the individual partners, so it has pass-through taxation just like an LLC or a regular partnership would. An LLP must be formed by filing a certificate with the state, so the Secretary of State's office in Jefferson City, and it has to have LLP somewhere in the name so everyone will know what kind of entity it is. But in many states now, you can have an LLC or an LLP and operate your business like you would, pretty much with a regular partnership. However, you will be much safer from litigation than you would have been years ago. Now we're going to talk about a pretty large and the most complicated business organization we can have, and that's a corporation. And they can be small, but they can also be extremely large. The biggest companies in the world are corporations, and they can get very complicated as well. So we'll take a few slides here to kind of look at the characteristics of a corporation. They've been around for a very long time in one form or another, going back hundreds of years. They are quite a bit different from the other business forms we've seen so far, and as I said, they can be pretty complicated. This complexity and also the tax treatment of corporations make them an unpopular choice for a small business. However, a very large company may have no choice but to form a corporation, which is a process we call incorporating when they are forming that corporate entity. One major difference between a corporation and the other entities that we've been looking at is that a corporation is a legal person. Just like you're a person and I'm a person and all our friends and family are people, the law looks at a corporation as a person too. And it has liabilities and rights and things like that just like a actual biological person would too. Um, and partnership is not that way, and the LLC and those other things. They don't have a separate legal existence, but a corporation does. It is separate and apart from its owners, legally speaking. It is its own entity. A corporation can buy and sell property in its own name. If you're doing that with a partnership, you'd have to put the property in the name of the partners. You couldn't have, the partnership itself is not a separate entity that can own property, but a corporation can. A corporation can sue and be sued in its own name. The only way you can sue a partnership is to sue all of the partners and name them as defendants. But if you want to sue General Motors Incorporated, you just sue GM. It can sue and be sued in its own name. A corporation pays taxes on its own income and files its own tax return. So the IRS looks at it as a person as well. It has an existence that goes beyond the lives of the people who founded it. It can go on for basically ever. There are corporations in existence now that are, hundreds of years old, and these corporations can potentially last until the earth burns up or our legal system collapses. So they're not tied to the life of a biological person. They can just keep on going forever, as long as the legal system allows them to continue. Corporations are separate entities, independent of those who create and run them. So once you start a corporation, it kind of takes on a life of its own. It's a little like Frankenstein's monster. People create it, but it, kind of does its own thing. It can continue on after those people are long out of the picture, either, moved on to, do something else, or they've passed away or whatever. A corporation can keep right on going, kind of takes on its own life. The folks who found a corporation file the appropriate paperwork with the Secretary of State's office in Missouri, that'd be in Jefferson City, and then poof, they've created a new legal person with its own rights and liabilities. So a very different concept. We're creating a legal person when we create a corporation. In a corporation, the people who actually own the company are called shareholders because they own a piece of the corporation, or what we would say is a share of stock. And that share of stock entitles them to share in the profits that the corporation is able to make, and also gives them some control over how the corporation is run. A corporation can decide how many shares of stock it wants to issue to the world at large. For example, a company might sell, let's say, 10,000 shares of stock at $10 per share. So by selling that stock, they will generate $100,000 that they can then invest and start doing business with. They can, buy a new factory or, whatever they want to do with that money and try to use that money to make more money. In return, the shareholders who buy that stock, they will own the share of stock, and as a result, they will get to share in the profits. If that company makes money, they will get a check. And they will also get a voice in running the company, and that voice is proportional to the number of shares they buy. So the more shares they buy, the more voice they will have in running the company as it continues on. Shareholders have limited liability. They can lose what they've invested in the company, but they do not have personal liability, so they won't lose their house and their boat and all that other stuff. As we said, a corporation is its own separate legal entity, and as a consequence, it has to file its own tax return and pay taxes on its income. If the corporation makes money, it usually will distribute a portion of its profits to its various shareholders. When it does that, that's called declaring a dividend, and that money that it pays out to its shareholders is the dividend. And so if you own a share of stock in a company and it's making money, you'll usually get some money from that company, which is basically they're just divvying up the profits among the various shareholders. The dividend is paid out to shareholders a specific rate per share. And so the company, the board of directors, will decide that. It might be like 25 cents per share. So if you pay $10 for a share of stock and you get 25 cents back, okay, that'll add up over time. If they do that every quarter, eventually you'll make all the money back and then some. It's a stream of income. The dividend then becomes income to the shareholders, which means they must list that on their individual tax returns. And so let's stop there and think about this situation. The money that a corporation earns is taxed twice. The corporation earns the money and they have to pay income tax on that. Then they turn around and give that money that they earn back to the shareholders, and the shareholders have to pay taxes on it too. That is double taxation, and it really stinks. That's the major drawback to a corporation as a business form, along with the complexities that you have to take care of in the paperwork. But that double taxation is a killer because the company pays taxes on the income once, then they give that income over to the shareholders who pay taxes on it again. And so the government taxes it twice, which is just kind of mean, honestly. The nice thing about it, if there is one nice thing, is that the corporate income tax rates are usually lower than the rate for individuals. And so at least, it's not going to be as big of a bite as it could be. But of course, no one wants to give the government two chances to tax your money. Because that's just wrong. And so that's one major drawback of having a corporation, is that money gets taxed twice. Once the corporation has to pay taxes on it when the company earns it, and then the shareholders have to pay taxes on it again when they get it as a dividend. And so it is taxed twice, which is a bad deal. All right, well, we were talking about regular corporations. Let's talk about S corporations. And corporations in general are kind of complicated. Probably the most complicated type of business entity you can have. There's a lot of rules to be followed, forms to be filled out, tax returns, all this kind of stuff you have to do. And no one, of course, wants to be taxed twice. And so there are some drawbacks to a corporation. Traditionally, the largest businesses choose to do business as a corporation because they will get to do things they have to do, like raise capital by selling stock. And so that's really the only kind of organization that allows you to do things like that. And so they have to be just a regular, plain old corporation. They can't really avoid it. However, Congress in 1957 decided to be nice to the little guys. And they started to allow certain small corporations with a limited number of shareholders to avoid that double taxation and instead use pass-through taxation just like an LLC or a partnership would. And so a corporation that qualifies for this treatment doesn't have to pay taxes on its income, but the shareholders have to claim the income on their personal tax returns just like if they were partners in a regular old partnership. And so it's only taxed once, which is really nice. This part of the tax code that Congress did this in is called Subchapter S, and so these entities just became known as S corporations. And so if you hear of an S corp, this is one of these kinds of entities. Regular corporations, by the way, fall under Subchapter C, and as you might imagine, they are called C corporations. And so that's just a regular kind of corporation is a C corp, and one of these special ones is an S corp. An S corp has a disadvantage, and that is that there are limitations on how many shareholders there can be. This is really designed to help out like small family-owned companies or just kind of a regular small business. And so there are some restrictions. Another corporation can't be a shareholder in an S corp, for example. And the total number of shareholders is limited, and the kinds of stock they can issue are also limited. And these limitations force larger businesses to be a C corp because they just can't do what they need to do as an S corp. But this is very helpful for some smaller companies. They can do business as an S corp, especially like a family-run business or something like that. They can avoid a lot of those bigger headaches that come with a C corp. And of course, that pass-through taxation is the biggest advantage that they have. They only get their income taxed once instead of twice. Yet another type of business organization we need to look at briefly is what we call a professional corporation. And this occurs in pretty much every state now, including Missouri. They all have special business entities that are based on the LLC or LLP or a limited partnership kind of model, but they're designed solely for businesses made up of people providing professional services like doctors, lawyers, accountants, or that kind of thing. In Missouri, it is not uncommon at all to see a law firm with PC after the name, and that just stands for Professional Corporation. In Arkansas, you'll see PA, which stands for Professional Association. And so different states kind of have different takes on this, but that's kind of the same idea. And a partner in one of these firms can enjoy limited liability if the other partners do something naughty. And so I mentioned that Texas law firm several slides ago, where one of the partners did something horribly bad, and all the partners lost their shirts. Well, we don't really want that to happen. Doesn't really make sense. It's not that fair to the other partners who didn't do anything wrong. And so states have allowed these professional groups to form these kinds of organizations. And so it has a lot of the benefits of an LLC or an LLP or something like that, but it's designed just for professional organizations like doctors, lawyers, accountants, and that kind of thing, and has some special features that help them out. So if you see one of those, that's what they're talking about there. Now let's talk about how these different organizations actually run. How do we operate them? So let's take a look and see how they actually function. Most of the entities we've looked at, other than a corporation, really draw their inspiration from just a plain old garden variety partnership. And so we'll look now in some general terms about how partnerships work, and by extension, be also thinking about limited partnerships, LLPs, LLCs, and things like that, because like I said, they pretty much all draw their inspiration from the partnership rules. And so we'll look for a little bit at how partnerships operate, understanding that by extension, we're also looking at how limited partnerships, LLCs, and these other kinds of entities also work. A partnership can start with no formalities at all. You do not need to fill out a form to start a partnership. And so that does distinguish just a regular old partnership from most of the other kind of organizations that we've looked at here, because you don't have to file anything with the Secretary of State's office. If you do want to start a limited partnership, LLP, LLC, anything else basically, there will be a need to file some paperwork with the Secretary of State's office. Having said that, though, even in a regular old partnership, and certainly in these other entities as well, partners can and ought to have a written partnership agreement. And that's basically a contract between them agreeing on which partner is going to own what property that's part of the business operations, how the different partners interact, what happens if one of the partners decides to leave or passes away, and we'll also, prepare for other kinds of eventualities that they might run into during the course of running the business. Once the partnership is underway, the UPA says that no new partners can join the partnership unless all the existing partners agree. And so that's kind of nice because, if you're going to be on the hook for what this person does, it makes sense that everyone ought to agree before we let somebody new into the fold there. Also, a partner can't transfer or sell his right to manage the business to anyone else unless all the other partners agree to it. Now, what he can do is transfer the right to profits. And so let's look at an example to kind of illustrate how this works. Let's say that Sid is in a partnership that is a lawn mowing business. He has two other partners. Sid wants to get out of the business and retire and sell his stake in the business to Kenny. Only if the other partners agree will Sid be able to sell Kenny the right to participate in the management of the business. And so unless everyone else is on board with it, Kenny can't come and step into Sid's shoes here and start running the company, okay? Not unless everyone else agrees. So without their agreement, all Sid is able to give Kenny is the right to share in the profits. And so that would basically make Kenny a passive investor who doesn't actually help run the business. Now, if all the partners agree, yeah, we want Kenny to work with us, then he can run the business. But if just one of them doesn't like him, then he won't be able to actually manage the company at all like a regular partner would. All he will be doing is cashing the checks, just like a regular passive investor would. And so that is kind of a safeguard there for the other partners, so one partner can't unilaterally sell his stake and suddenly you're in partnership with somebody that you didn't want to be in partnership with. And so you can kind of see why that rule exists. Remember, the partnerships aren't a separate legal entity like a corporation would be, and they have no separate legal existence on their own. So it makes sense they can't own property on their own either. And they can't put it, a partnership can't put it in its own name because it doesn't exist. And so what would happen is that the business would have to hold all property in the names of the individual partners. And so they would all have their names on this property. That can end up being a kind of a nasty problem, especially if the business needs to own land somehow or other, because then the land would need to be owned by all the partners. Well, guess what would happen if the business ended up adding a new partner or lost an old one? Well, your land would be would be titled to the wrong people. And so you'd have to retitle the land somehow. And that could be just a real mess. The UPA did a little bit to ease this problem, but partnerships are still kind of clunky in dealing with this sort of issue, and it's difficult for them to own their own assets. And so this is a drawback of a partnership kind of situation. Each partner has the ability to act as an agent of the partnership, which means that he can enter into contracts on behalf of the business. And so if you have, 10 partners, just one of those partners can go sign a contract and the whole partnership is on the hook for that. So all the partners will be bound by the acts of what any one partner does. Well, that can be a problem because if you end up with a flaky partner you can't trust, they can go around signing contracts. They'll get you into all kinds of trouble, and any stupid decisions that one partner makes will end up binding all the other partners, and they will be on the hook. So, for example, if your stupid partner goes out and takes out a big old loan, without asking anybody else about it, well, then the partnership is bound by that, whatever he signed, and all the partners can be liable for the debt. Or let's say you have a stupid partner who commits a tort or breaches a contract. Well, all the other partners are going to be liable and they'll be sued. And since the general partners are personally liable, their personal assets could be at risk. And so that's a bad deal for if you're in a partnership. If you have one loose cannon partner, they can really get everybody in a heap of trouble. Well, this looks like a pretty bleak situation, but the good news is that partners do have a legal duty to be loyal to the business and to each other. They're supposed to be looking out for each other's best interests. They owe each other a duty of good faith and fair dealing, is what we call it in the law. That means that they cannot purposefully do anything that would harm the business or the interests of their fellow partners. So they're not supposed to be going out, and breaking contracts and committing torts and those kinds of things that will get their other partners in trouble. Of course, they might inadvertently or stupidly do something, but at least they're not supposed to be intentionally doing anybody any harm. We do have a problem sometimes where we have a situation where one partner leaves and goes off to start his own business that ends up competing with the old business that he left. So let's say that Jerry and Buddy are partners, and Buddy gets mad one day and leaves and starts his own scooter business and goes into competition with Jerry. Well then, we violated that good faith and fair dealing there, and that can end up becoming a problem. And so where that duty of loyalty ends can be kind of tricky to sort out, kind of a mess sometimes. The UPA, Uniform Partnership Act, says that any time a partner withdraws, which just means leaving the business for one reason or another, dies or becomes bankrupt, then the partnership is automatically dissolved. And dissolved is a special legal term with a special legal meaning here. What it doesn't mean is that the business immediately closes. It might, but we don't know that. So a dissolution can actually go a couple of different directions. When dissolved and dissolution, of course, are different forms of the same word. So when we have a dissolution, we have a couple of choices. If all the remaining partners agree to keep the business open and continue on, they can. And at that point, it's like forming a brand new partnership without the old partner. And so they will just kind of like, in a married couple renews their vows after, being married for 30 years or something. Kind of the same thing. The partners will renew their vows only without the partner who left. And so they'll say, okay, Bob left the partnership and he's gone, but the rest of us want to keep on going. And so they will kind of renew the partnership and carry on. If even one of the remaining partners doesn't want to continue the business after Bob leaves, without that old partner, they can force the business to close after dissolution. And so they can say, nope, sorry, Bob being here was the only reason I wanted to be in partnership with the rest of y'all, so, I'm ready to close the business. And they can force that to happen. So kind of another reason why partnerships may be kind of a bad idea, dealing with these situations where people come and go are pretty problematic sometimes. But so we have basically two choices: continue on without that partner who left, or close the business. And so the partners will have to figure out what they want to do. If we do end up closing the business, that happens in 3 steps. First, we have what's called a winding up of the business. And that just means that the partnership won't start any new business, and it starts trying to wrap up old business and get all its outstanding work that it's working on finished, basically. So for instance, if we had a lawnmower repair business and it was winding up, we wouldn't accept any new customers at all, so no new business, and we'd try to get all the broken lawnmowers in our shop fixed and out the door as soon as we could, get them out of the way, and so we could close our doors. And so they would just try to finish what they started and try to wrap everything up and not accept any new business. As soon as the business is wound up, there is a liquidation, which means that the partnership assets are sold or split up among the partners by agreement. And so we have to dispose of the property that's being used as part of the business. And that may still be, titled in the name of one of the partners because they just contributed it to the business. But if not, if it's held by more than one, we'll have to figure out, do we sell it? Does one of us keep it, or how does that work? And so once that's all done, finally, the partnership can terminate, which means that it's paid all of its bills, closed all its accounts, and it can finally just close its doors and cease operations. And so that's the steps we would go through if we were going to actually close the business after a dissolution. Well, we talked about many different aspects of partnerships, and I think the moral of the story, at least in my humble opinion, is a partnership is always a bad idea. At least just a plain old garden variety partnership. There's so many pitfalls that you can run into. It's very clunky as a business form because of the way decisions are made, what happens when new partners want to come in or old partners leave. It can really mess things up. One bad partner can end up ruining the whole business. And we saw how they're an agent for the whole business. They can go out and sign stupid contracts and get everybody in trouble. There's liability issues. If a partner dies, that can cause all kinds of chaos. Just all kinds of drawbacks, basically, to a plain old partnership. And there's really no need for getting into one of these when we have all kinds of cool things like LLCs and other more modern inventions. It just seems silly to get by with an old-fashioned partnership. So if you're going to go into business with your buddy, my advice would be find some other business form than as just a regular old partnership. There's just so many better options out there and so many drawbacks to doing business as a regular old partnership. We're going to change gears a little bit now and talk about corporations. And corporations are a little bit different than everything else that we've looked at up to this point, but they are very, very important. The biggest companies in the world are corporations. Every state has its own statutes describing how corporations are formed and may be run. They're not a creature of the common law. They're defined by statute, and that's how we know what powers they have and the rules they have to follow. It's all based upon statute, and every state has its own scheme for figuring that out. To have a corporation, the people wanting to create one must carefully follow all of those rules, or no corporation will be formed. And so you cannot form a corporation by accident. A partnership could be formed by accident. If there's just a couple of guys in their garage making widgets or something, you could accidentally have a partnership, basically, just by following the definition, the UPA or RUPA. Two people carrying on a business for profit, you have a partnership. You don't have to file any paperwork or anything. Corporation's not like that. You have to do that on purpose. There has to be papers filed in the Secretary of State's office and that sort of thing. So, much different way of going about it. Some states try to have very easy, flexible rules on corporations, and they do that trying to attract business. We saw how Wyoming created the LLC trying to become a business mecca, while other states have done that too, trying to attract corporations. And the most successful one is the unlikely little bitty state back east, Delaware. It has a very business-friendly set of rules, and it has attracted some really large companies who set up shop as a Delaware corporation. That's kind of been a fashionable thing. The biggest companies would incorporate as a Delaware corporation just to take advantage of its rules. Even Walmart, which is based in, down the road in Arkansas, is a Delaware corporation, and many corporations are because of its friendly rules, and also because they handle so many corporate law cases. The law there is very sophisticated. The judges really understand corporate law very, very well because it's been such a popular place to incorporate your business. And so it's just a pretty happy place to do corporate law, basically. And so lots of companies have incorporated as a Delaware corporation. If we're going to create a corporation, the first step is to file what are called articles of incorporation. Kind of like the constitution of your company, basically. It's just a formal document that sets out the name, the purpose, who the initial owners of the corporation are. It is filed by people called incorporators who are founding the business, and it is filed with the Secretary of State's office in Jefferson City if you're creating a Missouri corporation, at least. When we look at the articles of incorporation, there will be a number of things included in there. First, it'll come up with a name. They have to pick a name. Can't be one that's already been used because we don't want people to be confused, and so they'll have to check the database first and make sure that no one has used that name before. They will have to state how long the corporation will last. Used to be you had to pick a definite time, but now most people say that their corporation is perpetual, meaning that it can go on to the end of time. So it does not have any particular ending date to it. And the law now allows you to do that in most places. It'll state the purposes and powers of the corporation. You could be pretty specific about that, like, an example, to manufacture and sell running shoes. However, most states allow you to get by with something much more vague than that, and that would be a wise thing to do. So the common language is any lawful purpose. That's what most people do, and that makes sense because, you don't know if you found a running shoe company, you don't know 75 years from now it may, being tried to sell electric generators or something. You have no idea who may merge with somebody else or acquire some other company or who knows what. And so it's best to leave that vague if you can get away with it. We'll also name the initial board of directors, and this is the people who will actually run the corporation. They will hire and fire the CEO and the other corporate officers and, kind of control the strategic direction of the company. It will explain how the corporation will be capitalized or funded, which means the incorporators have to figure out how to get money transferred into the corporation so it can do business. For example, it might issue shares of stock and then sell those shares of stock. And so the articles of incorporation will specify that. It will state the name and address of the registered agent of the corporation. You have to have a registered agent if you're going to do business as a corporation. And that's the person who will accept papers if somebody sues you. And so you just have to have, because a corporation's kind of a nameless, faceless thing, and so we require there to be somebody who is designated, as a contact person if you have a lawsuit against the corporation. And so you have to designate some kind of registered agent. There are companies that actually do that for pay, who will accept service of process if somebody sues you, and you can list them as your registered agent for a fee. But you have to have someone within the state borders of Missouri who is willing to accept service of process on your behalf. And then, of course, if they do get served with papers, they will notify you right away, hopefully, and tell you you've been sued. But you have to have somebody out there who will accept that service of process. The articles will also state how many and what kinds of shares of stock the corporation is authorized to issue and sell to the shareholders. This is usually the primary way a corporation will get the money it needs to start up, is by selling some stock. And stock can be classified in different ways. Common stock is what most shareholders will own, and it carries a couple of important rights with it. The first is the right to get paid dividends that are issued. So if the company declares a dividend, in other words, it's dispersing its profits to its shareholders, each share of stock will entitle you to a share of that dividend as well. Also, the share of stock gives you the right to vote on issues concerning the company. So if something comes up for a vote, picking somebody new for the board of directors, for instance, or some major issue that affects the company, that share of stock will entitle you to a vote on that issue. We also have something called preferred stock, and it carries with it more rights than common stock. Owners of preferred shares may get a bigger share of the dividends. They may get paid dividends even if no one else does who has common stock. They may also get more voting rights. They may be, one common share of stock, you only get one vote, but for every share of preferred stock, you might get 5 votes, for instance. And so companies can set that up different ways depending on how they want to do it. Sometimes the founders of the company, like, if you're talking about Ford Motor Company, Henry Ford had preferred stock when he went public. He was able to keep control of the company through that. So it just depends on how the company wants to set things up. They may just have nothing but common stock. They may have some insiders of the company that have the preferred stock, and then everyone else has common stock or whatever, but they can kind of set that up however they want to, as long as they follow the rules. A corporation can be classified based upon how many shareholders it has and whether its shares are publicly traded or not. If we have what's called a closely held corporation, usually it just has a very few shareholders. And so it can even just have one shareholder, and that's perfectly fine. And usually this situation comes up when we have something like a family-owned business, or just, what might have been a partnership, except, now we're a corporation. And so there's just a few people trying to run the enterprise, and so they will all have shares of stock. But this is a closely held corporation, which means it's not publicly traded. And so you can't go to your stockbroker and ask him to buy stock in a closely held corporation for you. It's not on the market. It's not listed on the NYSE or the NASDAQ or any of that stuff. It's just a few people that hold it. Closely held corporations are sometimes called privately owned. And they are free of many of the public reporting requirements that corporations with more shareholders that are publicly traded are subject to. If you list your company on the NYSE or something, there's all these kinds of hoops that you have to jump through that doesn't exist with a closely held corporation. Well, the alternative to a closely held corporation is a publicly held corporation, and it usually has a lot of shareholders, and it will market its stock to the public at large, which means that anyone with the money can invest in the company by buying shares of stock in that company. Usually, the shares for such a company will be for sale on a particular stock exchange, such as NYSE or NASDAQ, something like that. As a consequence of that, publicly held corporations often have lots of shareholders, sometimes millions of people when you're talking about a really large company. Because they are marketing their stock to the public, they have to comply with very strict reporting requirements. So, for example, certain company transactions may have to be made public if they're trying to merge with another company or buy another company or something like that. How much money the company is making or losing has to be reported and becomes public knowledge. And so you cannot keep the financial health of your company secret if it's publicly held, because the public has a right to know how well your company is doing before they buy a share of stock. And so you have to make that publicly known. And so that's one drawback, potentially, of a publicly traded company, is that its books are open to everybody, and so even its competitors can see how well it's doing. So sometimes that might not be desirable. The company is ultimately run by the board of directors, and that is who is ultimately in charge. And we set that up through the Articles of Incorporation, who the initial directors will be, and then they can be elected by the shareholders later as we have some turnover on the board. They have the ultimate authority for the strategic direction of the company. They're supposed to be keeping an eye on where the company is headed, kind of the big picture sorts of things. Usually, the board is composed of several people who meet regularly, usually quarterly, to discuss issues facing the company. And so they'll look at the financials, see how the company's been performing, and they may vote on large strategic issues, whether we're going to, try to enter a new market, for example, or are we going to try, selling our widgets in France or something like that. Or, if the company's going to acquire another company, they might have to vote on that. The big strategic moves they will discuss and make sure the CEO is doing a good job and the company is on track. They will also vote on when to issue dividends and how much those dividends should be. So they will figure out what to do after the company's earned a profit. Do we hang on to that money and reinvest it? Do we give it back to the shareholders and by declaring a dividend, or what do we do? So they will figure out those issues also. However, the board does not run the company on a day-to-day basis. They will keep an eye on its strategic direction, meet at least 4 times a year usually, but they will not be there in the office every day managing the company. Instead, they will hire people to do that, who are called officers. And the person who is in charge is an officer called the Chief Executive Officer, or CEO. And so that's the person who is in charge of the company on a day-to-day basis. Oftentimes, they will also have other officer positions. The Chief Operations Officer, or COO, is a popular one. And pretty much every company has a CFO, or Chief Financial Officer, who is in charge of keeping the books, usually a CPA in a large company, somebody who's really, really good with finances. A corporation may also create other positions, such as vice presidents, for various things, and that'll just depend upon how the company is structured. If it has different company segments that are making different kinds of widgets or something, they may have a vice president for every branch of the company, however they want to organize it, but they may have other officers as well. These officers are the ones who actually run the company, while the board gives that strategic direction and oversight. And so the board will kind of set the direction and say, okay, here's what we want to do. CEO, go make it happen. And so the CEO is in charge of actually running the company on the day-to-day basis. And the board has the sole authority to hire and fire a CEO. And so they will decide if the company is performing badly, maybe let the CEO go and look for a new one. But they will be able to figure that out. Well, every year the corporation will hold a shareholders meeting where issues facing the corporation are put to a vote of the shareholders. The shareholders will get usually 1 vote per share, and that can be adjusted though, and shareholders with preferred shares may get more votes, as we discussed earlier. There may be issues the board of directors places before the shareholders for a vote. in order to decide the direction of the company. So if it's a really huge decision or it's one that the law requires the shareholders to approve, the board may place that before the shareholders and they get to vote. And they can physically show up at the meeting to vote, or they may vote by proxy or something like that. It can get kind of complicated, which we don't need to get into really. But the shareholders will get a chance to choose the direction of the company. Also, the shareholders get to elect new members to the board of directors when there's a vacancy. And so they will get to figure out who they want to be on the board. Along with the articles of incorporation, which tend to be very general and just kind of get the corporation up and going, the corporation can also adopt bylaws. And these are rules that govern exactly how the corporation will operate. And these articles are filed with the Secretary of State's office, and so they're going to be public record. Anyone can go look at them. And actually, in Missouri at least, you can go on the Secretary of State's website, pull up a public corporation, and go find its articles of incorporation and read them if you want to. Bylaws are not like that. They don't have to be filed with the state, and they're only for internal corporate matters, kind of our internal set of rules. So you can think of them like an operating manual for the company. They'll explain what the various officer positions do, what they do, how the corporation will go about completing certain types of transactions. They can get pretty detailed. It just depends upon the needs of the company, but they will kind of explain, as Acme Inc., this is how we're going to handle certain situations, and we'll explain how the company works internally. With a corporation, there is sometimes a concern that the owners of the corporation may use the corporate business as some kind of shield for shady activities. Remember, the main reason that we have a corporation or other, one of these forms of business organization is a shield for liability. And so you can see why a person with an evil heart might decide, hey, if I want to do bad things, I might form one of these business organizations. That way I won't get sued. They'll just, they'll sue the corporation, but they can't get me. They can't get my personal assets because I'm not personally liable anymore. And so, because shareholders don't have that personal liability, unscrupulous people might say, hey, let's set up a corporation, and carry out our scam behind the shield of the company. Then if someone figures out we're a scam and tries to sue us, we'll hide behind the corporation and they'll get its assets, but they won't be able to get our assets. Well, that would be unfair, be abusing the whole idea of a corporation in the first place. And so courts have developed a doctrine called piercing the corporate veil. And that's a situation where the court will, in special circumstances, ignore the existence of the corporation and, in fact, make the owners personally liable for what they were doing. When you pierce the veil, that usually only works when the existence of the corporation itself was just a sham. And we can show that by looking at how the owners really acted. For example, they're supposed to have regular board of directors meetings. If they didn't have those meetings, that's a good sign it's a sham. If they failed to file some paperwork they were supposed to do. A big one is if they kept corporate funds in with their personal funds. If they didn't, have a separate bank account for the corporation and they just, kept the money intermingled and stuff, that's a really good sign that the corporation itself is just some kind of fig leaf to cover up what the owners are doing. So it'll depend upon the particular circumstances. But if the court figures out that, hey, they weren't really trying to do any kind of legitimate business, they just set up this corporation to shield themselves for liability when they were trying to do something naughty, then the court may ignore the existence of the corporation and hold the shareholders personally liable for whatever they were doing. So that's, I guess, a warning to you if you had this evil idea of setting up a corporation to go do something naughty. It may not work because the court might see right through that and still hold you personally liable if you're trying to use the corporation just as a shield, to keep you free of liability for whatever bad things that you are trying to do. The officers and directors of a company have a duty to act in the best interests of the company as a whole, as well as its shareholders. And we say that's a fiduciary duty, which is kind of a special duty, kind of like an attorney has to a client or a doctor has to a patient, to do, use the highest and best care, put their needs first. You have to really try hard to put the best interests of the company and its shareholders in number one spot here. So, of course, they should never purposefully do something that would bring down the value of the company's stock, that would hurt the shareholders. So they can't purposefully do something that would hurt the business, basically. They have to act in the best interests of the shareholders. Also, they have a duty to be loyal to the company and not do anything that would create a conflict of interest. We can have an example of this here. Let's say that Sarah is on the board of directors at Tapeco, which manufactures tape dispensers. Secretly, Sarah buys stock in Tapeco's main competitor, Taperama. Then Sarah convinces the other directors of Tapeco to make bad business decisions that causes the price of Tapeco's market share to drop. This causes Tapeco's competitors to start posting big profits, and Sarah is happy because the value of her Taperama stock goes way up. So Sarah there is quite the scoundrel and abusing her position on the board of directors of the company to help her personally, to help her own pocketbook here. So clearly that's a conflict of interest, and that would be violating this duty of loyalty. And so we can't allow things like that to happen. That, of course, is an extreme, maybe silly example, but it shows what happens if a director violates that duty of loyalty to his or her own company, and we can't have that. If a director or officer of the company does something intentional or negligent that hurts the shareholders, then the shareholders have the power to file a lawsuit against the directors of the company they own. And so the shareholders are the ultimate owners of the company, and they kind of hire the board of directors to run it. And so if the board of directors does something shady, they can hold them accountable by filing a lawsuit. And this is called a shareholder derivative suit. And so they will ask a court to come in and say, hey, court, we're the shareholders, we own this company, and the board of directors did something horrible. Please step in and make them behave. And so that's what a shareholder derivative suit is all about. Suing the directors of the company you own stock in is kind of an extreme thing, but it does happen occasionally when directors do something pretty controversial, and as a result, the company's stock price goes way down. So the shareholders may have suffered, some pretty significant financial losses based upon the board of directors screwing up, and so this is what they can do about it, is file this lawsuit. Well, corporations aren't always run in the best possible way. I say within the last decade or so, maybe I may have to update that because it's going to be 10 years and longer here pretty quickly. But there were a number of scandals in the 2000s in the corporate world which inspired some tougher government rules and greater oversight of how corporations operate. One of the most important laws that are in this area is called Sarbanes-Oxley, named after the senator and the congressman who sponsored the bill originally when it was introduced into Congress. And it was enacted in 2002 in response to the collapse of Enron and WorldCom, which were some huge companies that just went belly up, basically through fraud and mismanagement. And they took a lot of shareholders' money with them that just went poof. And a lot of people ended up much poorer as a response to the collapse of these companies. And so this law was passed, which requires publicly held companies to keep very careful records of their financial and accounting activities, requires that senior executives sign off on financial reports, and that makes them personally liable for fines and penalties if the company is doing something shady on their watch. And what happened with WorldCom and Enron, too, the company officers were doing some shady stuff. Basically, they were kind of falsifying information and doing some other illegal things to prop up the value of their company. And so their company looked like it was enormous and making money hand over fist, and in fact, it was just kind of a pyramid scheme. Wasn't really making money at all, and people found out the emperor had no clothes, and the whole thing collapsed, and the shareholders lost their money. And some of the officers of the company were saying, well, I didn't know what was going on. Well, Sarbanes-Oxley makes sure that they do know what's going on, because they have to sign off on the financial reports and things like that and say, by signing it, they're saying, look, I looked at it, I think it's accurate. As far as I know, everything's on the up and up. And then if it turns out that they were hiding something, then we can throw them in jail, get a lot of money out of them, that kind of thing. And so it helps ensure responsibility. Well, Sarbanes-Oxley, or just SOX as it's called sometimes, made some good reforms, certainly. We saw the need for that in the early 2000s. However, some critics say that it went too far, that it placed burdens on businesses that are too high. There's just a lot of paperwork involved with Sarbanes-Oxley. It's quite burdensome, for a lot of companies to have to deal with all of its requirements. So much so that especially international companies that were already operating in other countries actually relocated their headquarters outside of the United States just so they could avoid this law. And so it was pretty burdensome. And so there was a healthy debate on whether it just did what was necessary, or if it kind of went too far and placed some onerous burdens on corporations to report what they're doing and that sort of thing. And critics would say it ran off businesses that left the country and took jobs with them. So there is a healthy debate about that, but certainly there was a need for oversight, and that was demonstrated by some of these scandals that happened back in the 2000s. Well, let's say that you're wanting to start a business. If that's so, you have a lot to think about. We've looked at the different business forms, asking the question, which one do I want? There's a lot to consider in that, answering that question. Just about everyone would be wise to have some kind of business form that gives you limited liability. We've seen why that is, and of course partnerships don't do that, and sole proprietorships don't either, but there's certainly lots of things out there that would. And so if you're going to be in some kind of business, it would certainly make sense to protect your personal assets so you don't end up homeless and carless and boatless and whatever else and lose all your personal assets. There's also tax implications to be concerned with. If it's a small kind of venture, an LLC or something similar may be a good choice. If you don't mind having all that income on your personal tax return, that would be fine. But if you need to raise large amounts of capital, such as by selling stock, you may be forced to form a corporation so you can sell those shares. The truth of the matter is there's really no one-size-fits-all business form. It really just depends on circumstances, what you want to do, the kind of things you want out of your business, how big it's going to be, how you need to capitalize, all that stuff. And so if you find yourself in that situation at some point, it might be worth your money to go consult with an attorney who works regularly in this field. That's not me, by the way. I didn't work regularly in this field. I know certainly a lot of stuff about this, but just by virtue of going through law school. But find an attorney that practices in this field on a regular basis, and they can tell you about the tax implications, liability issues, how it would operate, and kind of listen to your situation, help you figure out what would be the best form. So there's certainly a lot of choices out there, but maybe some professional advice would be helpful in that situation. Well, this is the conclusion not only of this video and presentation, but also the class. This is week 16, the last week of the course. And I just want to take this opportunity to say best of luck to all of you. I always enjoy having you all in class and getting to interact with you and all of that stuff. So I hope you've had a good semester. Hope you've learned some stuff you'll take with you for years to come. Hopefully that was my goal, not just something you could kind of flush out of your brain after the final, but something that you might actually find useful as you go about your business career. So good to get to know all of you a little bit through the discussion board and other things in the class. And certainly wish you the best and wherever life takes you. Hope you have a wonderful, successful business career or whatever else you find yourself doing. So with that, I'll say take care, best of luck to you in the future, and I will sign off.